according to the government of Canada, this is what you would need to qualify for up to 90% loan to value refinance to add a suite or suites to your property. So, number one, this measure will apply to all borrowers seeking to access mortgage insurance in Canada to add more units, secondary suites. These borrowers must satisfy and they said all borrowers because I guess they don't want to exclude, like, it's similar to the other ones. They don't want to exclude, like, it's not just for friends for family members or whatever, but you have to already own the property. And this is funny because there's this criticism that I've seen. We're going to get to some of the criticisms, but that people are like, oh, like, well, it does nothing because people already have to own the property. It's like, if only there was a way that people could own properties. Like, we should come up with a system like where they could buy them so that they could own them after. So because it's a construction loan and a refi, you have to own it. You can't get a construction loan on somebody else's house, right? Anyway, the borrower close relative has to be occupying one of the current units. Another criticism there, perhaps, that people will suddenly find a lot of close relatives, perhaps. It is intended to construct additional units, and the additional units must not be used as a short-term rental. So again, no Airbnb, etc. It's for long-term rentals only. It doesn't say anything about medium-term rental, which somebody has already asked me, which is interesting. Insured refinancing will be allowed for the purpose of building additional units. So I guess that would be the takeout. I guess you're getting a top up, like a construction loan, and then you're getting a takeout or a term debt at the end. The units must be legal. There's a maximum of 4 units. The maximum property value is $2 million. The maximum loan to value limit is up to 90% of the property value, including the value added by the secondary suites in combination with any outstanding or other outstanding loans secured by the property. So if you have like a capital stack going on, maximum amortization 30 years, and additional financing must not exceed project costs. There's a effective date starting January 15th, 2025, and all the other eligibility criteria for government guaranteed mortgage insurance will continue to apply. That one's interesting to me because right now CMHC has a comparable program. We're going to talk about it a little bit, but they only used 50% of rents for that existing program, which is why nobody uses it and why nobody's even heard of it. Like, people are out on Twitter complaining like, oh, the government shouldn't be insuring investment properties. It's like, they've been doing that since 2019. Like, it's a little late to complain. So anyway,
but that's what people do on Twitter, right?
Yeah, that's exactly what it was designed to do.
Now, I want to zoom in on one piece that you mentioned there, Dan, that as improved piece, I think is really important. And I guess we'll touch more and more on that in our next episode, which is, I guess, kind of a part 2 to this one. That's our discussion with EQ Bank. But Dan, this to me feels like a huge opportunity for house hackers, right? Which is something that, I think a lot of early on investors should consider. Now, here's a quick refresher, dictionary definition, if you will. A house hacking, simply put, is a strategy that involves becoming a landlord and renting out portions of your primary residence to generate income. So, for instance, you buy a property, you live upstairs, someone else lives downstairs, they pay your mortgage, or maybe you want to sacrifice a little bit more. You live downstairs, they live upstairs. Now, not only is your mortgage paid, but you're making money to live there. You're living for free and making a couple bucks on top.
Yeah, I think that this would kind of be like the super hacking version, though. Like, if there's like hacking, like, I'm just using computer hacking now, like Satoshi Nakamoto would be like this version of, like, that's how the best hacker ever, who was recently falsely revealed to be Mr. Something Todd, Peter Todd, who wasn't he an OCAD student? Anyway, seriously, I'm pretty sure that's the story.
That's
anyway,
wild.
Yeah. The fascinating part, though, is it's taxpayer insured, which kind of obviously carries a little bit of moral hazard and concern that people have had.
So on that note, let's do a quick run through and some examples, and then we'll get to those criticisms. So I'm a first time home buyer, trying to buy a house in a major metro area somewhere in Canada. I buy a
Probably not
raised,
Toronto based on the value.
not
Maybe,
Toronto,
maybe like Oshawa. No, I don't even think you'd get
not
in
Oshawa. Hey,
Oshawa.
what about Ottawa or Edmonton, something like that?
Sure.
Okay, so I'm buying my raised bungalow for $500,000. I am using a CMHC insured mortgage with just 5% down. I now own the house. I get the permits and the drawings and the construction budget showing that I want to put a basement apartment in there for $150,000. And when that's all done, the house will actually be worth $750,000. Now, I'm assuming I would get an as is, as complete appraisal done to substantiate that value. They would give me the financing for up to 90% of that new value, the ARV, which is the after repair value. So 90% of 750,000 is 675,000, but my total cost for the project and buying the house and putting the basement in, 500,000 for the house, 150,000 for the renovation was 650,000. So it actually net $25,000.
So I would say it's a little bit more nuanced than that because you also have the land transfer tax, which is 6,500 on that if it's in Ontario, 2,500 if you're a first time home buyer because you get a $4,000 rebate, plus the CMHC premium, which is important because they mentioned that it's all it's the same thing carries of all of the other ones. So if the premium carries from other CMHC loans, you'd pay 3.1% premium on a 90% mortgage with a 10% down payment. So you'd have to add 15,500 to the principal amount. So after that, you'd be pretty close to breaking even, depending on how much land transfer tax you pay. So the numbers are pretty tight. Now, the bigger question is, would it debt service the mortgage, right? And so we need to see because like I can't see them lending if all of a sudden you just qualified for that $500,000 house, and then you're adding income and you're trying to get a bigger mortgage. The income has to substantiate that increase in the mortgage, right?
Yeah, for sure. So let's start with that example. So $500,000. That's your price of your home with a 95% mortgage. So your mortgage amount is $475,000. That's 95% of 500,000. Your mortgage rate, let's just assume a 5% rate with a 25-year AM. The estimated monthly mortgage payment for a $475,000 mortgage at 5% interest over 25 years is approximately $2,777 a month. Now, if we are using the GDS ratio at 39%, that's your monthly housing costs, again, should not exceed 39% of your gross monthly income. This means that your gross monthly income should be at least $86,000 to qualify for that. So that would need you would then need to add that to the rental income for that property.
Yeah, so let's assume that unit, I don't know, a basement apartment in like I guess like Edmonton or I don't know, fringe GTA would rent for like $1,800 a month. So if you're looking to qualify for a $750,000 mortgage, again with the example at a 90 LTV, with the added income from the rental unit, the down payment would be, or your equity left in it would be 10%, leaving a mortgage amount of $675,000. CMHC typically allows 50 to 80% of rental income, depending on the lender's policies. So this is where you're probably going to run into challenges as it stands. I'm imagining they're going to have to make some changes here. Um, Again, that 5% interest rate. So your mortgage payment jumps up to $3,900, let's say. So assuming they count 100% of the rental income, it would work because I think you were making, I don't remember what the monthly income was before, but the $1,800 is less than the difference between your mortgage payment before and your mortgage payment now. Or sorry, more than the difference. Actually, in that example, it isn't even because it's 2,800 bucks before, and it's 3,900 now. So even then, it's pretty tight, right? And that's not accounting for the fact that you would have to hit a debt service coverage ratio. So this honestly just leaves me with more questions, and obviously, like a lot of this is going to come to light as they refine the policy and actually release the policy, and we start to see lenders' iterations of it. And we're going to obviously update the audience as that stuff comes out. But because I think that like and I want our audience to be aware and to be paying attention and to look for those answers, right? What is the DSCR? What is because these requirements are what's going to define it. Because like CMHC already has this rental property program where you could already get, I think, 90% LTV on an occupied duplex on acquisition, but they also have one for like 2 to 4 units. So are they going to include the rents? And if so, which percentage of the rents are they going to include? And how much are they going to be giving for the construction loan? And what format is the construction loan? Like the thing is called so far, this is like this arbitrary thing that we have right now, the secondary suite loan program or whatever.
Yeah, like what does that even mean?
No one knows what it means, but it's provocative. It gets the people going.
You're on fire today. I hope people can get that reference as well. But it's all kind of a nothing burger, right? Like if you Google CMHC income property, you'll see this result from February 22nd of 2019. CMHC income property is a mortgage loan insurance program that gives investors more financing options when purchasing a rental property. And the page goes on to say that loan to value ratios for homeowner loans, which are owner occupied properties, the loan to value ratio for 1 to 2 units is up to 95%. For 3 to 4 units, the ratio drops to 90%. And for smaller rental loans, which are non-owner occupied, so let's say your traditional rental property that you don't live in, loan to value for 2 to 4 units, so duplexes to fourplexes, drops down to 80%.
Yeah, there's this interesting little flow chart that they linked on the site. We're going to screen share it for those who watch the video versions of our podcast. There are like 5 people who do that, but it shows me that like this is why nobody is using the existing program. And again, it's because they only allow up to 50% of gross rental income, right?
Yeah,
or they use a net rental income approach.
So what I'm kind of getting is that this doesn't really change anything.
I mean, it increases the size of that program, I guess, from I think that capped at 1 million before, and now it's at 2 million. From what I'm getting, and it makes sense. So that makes it more scalable for owner occupiers, people who are going to do the house hack like you described. But it's not really new per se. This government is really good at repackaging stuff that already exists.
Yeah. Not the first time we've seen that old trick. Question for you, Dan. Do you think people will buy it? Do you think people will actually use it?
I do, and I know you do too. Like you're a big house hacking guy for sure. But I think we will get to that when we discuss the criticisms, because one of the big ones is that people don't think people will use it. I think it'll be impactful for larger house hacks and multiplexes, like where that's what it's going to take for the numbers to work. For example, if you buy an old McMansion and cut it up into 3 or 4 units, and you increase the value from 1 million up to 2 million, and you can cash flow it, that didn't exist before, right? Like there was no way to make that happen before. So there's definitely merit to the well-executed versions where people can pull up to 90% LTV, because now that person pulled a bunch of cash out and then they can go scale another real estate portfolio. Again, like they're not going to let you just pull 90 LTV. They'll let you pull up to 90 LTV wherever it cash flows. Again, like they're not just going to be because it's a multiplex, you can just have whatever mortgage payment you want, right? They'll say, here's what the rents are. Here's what your income is. Yeah. But I also think it's important to like really think about the idea of like almost stacking these big announcements that we've seen from the government since they started taking the housing crisis seriously, finally, because there are now a ton of programs you can take advantage of, which is pretty meaningful from my opinion.
Yeah, it's been crazy the last, I don't know, 3 months, maybe 3 to 6 months with like, it seems there's like a big new announcement like every week. It's been, luckily there's a podcast that covers all this stuff. It's hard to keep up with it all out there. So we're in the era of government funded financial hacking to get to home ownership. You can save money in your tax-free first home savings account, your FHSA, and you can max that out. Then save money in your RSP and use up to $35,000 per person for the down payment. Then you can deploy that on a house. You can convert that house to a multiplex and take out a 90% loan to value. So, if you can do what you just said, Dan, and stack these programs, we might actually be onto something.